I find I left my laptop's power plug in the office, and its battery is already low, so the slides may cut out on us, which will make things more interesting, in which case I'll roll up the screen and gesture wildly with my hands and actually use the chalk. We may make it, we may not. For logistics, as I said, we pushed back the assignments for All the Devils Are Here, so that chapters 16 through 19 are due after, or going to be discussed in sections after the midterm rather than before. And office hours. I'm not going to be here next Wednesday. Next Wednesday and Thursday are one of the 2 trips I had scheduled before I knew I was teaching this course in the middle of the week that I could not change. And so I'm going to be out of town on next Wednesday and Thursday, which means I'm not going to be here to proctor the exam on Thursday, and I'm not going to be here to run my office hours on Wednesday. So there'll be extra office hours. Tomorrow before lunch in Evans 601, Monday morning in the Free Speech Movement Cafe, and then Tuesday after class in the Free Speech Movement Cafe are going to be my pre-midterm office hours. Assignments, as I said, problem set 6. The sample exam is out, and it's due at 11 a.m. on Tuesday, March 8th, and please do write your section time on the front. And also there's a revised answer sheet to problem set 5, because people have pointed out to me that there are typos, or rather cut and pastos, in the answers to problem set 5. So I think I've corrected all of them, but re-download the answers to problem set 5. Now we have a March 10 midterm, and the other trip that I had scheduled before I knew I was teaching this class that I've been unable to change is around April 7th. It's a combined trip to the Wharton School at the University of Pennsylvania and then to a conference of the Institute for New Economic Thinking in Bretton Woods, New Hampshire. The Institute for New Economic Thinking being an organization established by financier George Soros with $100 million behind it to try to revise and make more relevant the teaching of economics and the profession of economics in American universities. And we here at Berkeley are keenly interested in this, first because it strikes us as in large part what we already do here, and second, because we're more than usually hungry for money, given what Governor Brown and the legislature are about to do to our funding support from the state, and given the extremely low level of in-state tuition that we happen to charge. So the way that Dariush and I have decided to run it is that we're going to have 2 midterms too close together. That is, it doesn't make much sense to have our midterms on March 10th and April 7th, but that's the best way to do it without losing another lecture. And so the March 10th midterm, we've decided, is going to be exclusively on depression economics, on the stuff we've been doing for the past 5 weeks now. And the stuff on economic growth, and also the stuff we'll do after the first midterm on inflation and the Phillips curve, that's going to be covered on the second midterm, which will be on April 7th. And here is the URL for problem set 5. Off the DeLong.typepad.com page after you check on the IAS 107 link. Once again, our commercial, our Berkeley Friday Political Economy Colloquium. We're going to have 3 people, Alan Karras, Mark Healy, and me, talking about the value of global history for modern political economy, what we hope you will learn or expect you will learn from studying history if you're a political economy major, and what you should learn if you're a business major. It should be fun. The Blum Center has promised not just lemonade that they provided last time, not just cheese and crackers, which they provided last time, not just appallingly healthy vegetables that they provided last time, but the Blum Center has also promised to get refined sugar there at 3:10 p.m., which I at least am looking forward to. It should be fun. Come and listen if you have nothing better to do on a Friday afternoon. Our recapitulations. Given that the midterm is going to be exclusively depression economics, being able to do the kind of two sets of equations from the income expenditure model takes on more than its normal level of importance right now. That we really want you to be able to, and more time, we really want you to be able to figure out equations like this. We really want you to be able to take the parameters of the economic model, of the income expenditure model, the tax rate, the consumption function, the marginal propensity to consume, the marginal propensity to import, combine them with our four parameters of autonomous spending: baseline consumer confidence, investment spending, government purchases, and gross exports, and crank out what the level of real GDP in an economy is going to be. That's an important skill we hope you have when you leave this course in figuring out how the economy works. And the answer we want, we have 3.579 trillion in the numerator. We're then dividing that by 1 minus 0.8 plus 0.2 by 0.4 in the denominator. So we have 9 trillion times 2.5. We have 22.5 trillion. That's the answer we're looking for. And I'd hoped you were doing better on this by now. Because if you're not in a week, the midterm is going to be pretty hard. We also want you to know not just the components of autonomous spending and the multiplier, but the income expenditure investment savings division. The income expenditure to investment savings division of all of this into things that are part of the economic environment, things that are government fiscal policy, are changes in government purchases, and things that have to do with financial markets and with monetary policy, things that affect the real interest rate and thus shift you up and down the investment savings curve, because as the real interest rate rises, investment spending and exports tend to fall. But first, before you get there, you've got to be able to figure out what these multiplier terms in the denominator are. Right? The fact that changes in spending, which change production, also change income. And when income changes, consumption spending changes and imports change, as people who feel more flush spend more, and as people who feel less flush spend less. And those feedback effects multiply, amplify the effect of the change in autonomous spending on real GDP. Here we have a multiplier. We have a 1 minus 0.75 in the denominator, which gives us 0.25. We have then this plus 0.0833, which is supposed to get us from 0.25 up to 0.33, which is 1/3. The inverse of 1/3 is 3. So we're looking for an answer of 3, for a multiplier of 3 here. It's not doing too well. And then once we have our multiplier of 3, okay, what's going to happen if the Federal Reserve and financial markets together, if the combination of those two processes together raise the long-term risky real interest rate R by 3%? What's going to happen to the level of real GDP Y in the economy if that happens? And let's give people plenty of time, enough time to actually do it in their heads or even on paper. And remember, you've just done the multiplier for these parameter values, that the multiplier is 3. So you've got to take whatever answer you get out from the change in the real interest rate and then multiply that by 3. Okay. And so we have a sensitivity of investment spending to the interest rate of 15, sensitivity of exports to the exchange rate of 0.5, and of the exchange rate to the interest rate of 10. Multiply 10 by 0.5, you get 5. Add it to 15, and you get 20. So in the numerator, you have a 20 in front of the delta R. Nothing else changes in the top. Government purchases don't change, and baseline autonomous spending from confidence in the environment doesn't change. So you have 20 times 3%, 20 times 0.03, which should give you a 0.6. Multiply it by 3, and you get 1.8. It's an increase in the long-term real risky interest rate, which means that businesses are going to want to invest less, so it's going to reduce real GDP. So the answer we're going to be looking for is D. Okay. And here we're up at 42%, which is significantly better. So maybe I should simply cut back on the length of the midterm. Maybe that will make things work significantly better. And I hear general assent. Okay, we'll cut back a little bit on the planned length of the midterm. The reason that we want to write things in this particular form, in this investment savings form, is it then gives us a very easy way to categorize how changes in financial markets and in economic policy and in the kind of baseline background of what's going on are going to affect an economy's level of production at any one point in time. Is something big happening to confidence, either to consumer confidence or to businesses' confidence that they won't be taxed out the wazoo, or to foreigners or to foreign exchange speculators' confidence in the exchange rate? That's going to change this delta A0 term and should leave the rest more or less where they are. If there's a change in the level of real GDP or in the level of real interest rates abroad, that's going to change this term and leave pretty much everything else unchanged. If you've been reading Paul Krugman's New York Times columns recently, you'll see he's been beating up. He's been beating up on the government of the People's Republic of China for continuing its large program of purchasing dollar assets in order to support China's export-led development, even through the recession. Paul's point is that China is now on its pre-2007 economic growth trend, while we are still 8% below. And so China shouldn't be taking steps to further stimulate its economy at the expense of ours while we're still depressed, and that it's doing so by acting like a very large foreign exchange speculator, by continuing to buy $40 billion a month of U.S. dollar-denominated Treasury and mortgage-backed securities, as if it's a foreign exchange speculator that has enormous confidence in the value of the U.S. currency, and that once you feed that through the determinants of exports, that's pushing down this term here, and hence through the multiplier pushing down the level of real output in the United States. And that's not a terribly friendly thing for an economy that's at full employment right now, or close to full employment, or facing problems of inflation rather than of mass unemployment, to do to an economy that's still suffering from significant excess unemployment. You can argue over whether this is, say, complaining about China is the right thing for people like Paul Krugman to be doing right now. I tend to think not. I tend to think that China is still a very poor country now. It's likely to be a rich country in a century. And for the sake of the safety of my great-grandchildren, I would very much rather have school children in China taught in a century that the U.S. did all that it could to help China grow rich as fast as possible, rather than that the U.S. was grinchy and requested big changes in Chinese economic policy in order to make the U.S. richer at a time when it was still vastly richer than China. That's a deep debate about what we in the world owe to each other and what the proper path for long-term global development and for economic policy and political economy is. But underlying Paul Krugman's argument is this equation here, and the fact that this delta A0 term, this change in baseline autonomous spending, that depends through the effect of the exchange rate on exports on speculator confidence in the value of the dollar. And right now, the People's Bank of China is the world's biggest foreign exchange speculator, continuing to bet for political, not money-making reasons, on the future of the dollar. So what foreigners do, and also what's happening to confidence, to business investment confidence and to consumer confidence, that hits this term, that leaves these rest virtually unchanged. Fiscal policy. Changes in the United States governments at the federal level, at the state and local level as well, and how much they buy in their purchases. That affects this G. When they purchase less, production will go down. Right now, the Republicans in the House of Representatives want to cut U.S. government spending by $60 billion over the next 6 months. That's over half a year during which U.S. production in half a year will be on the order of about $7 trillion. That means they want to get rid of 1% of the demand for U.S.-made goods over the course of the next 6 months. Apply the multiplier of 1.5, which Christy Romer has decreed that we should use in thinking about fiscal policy to that. You get a prediction that as this reduction in spending hits, if it does hit, that you'll wind up pushing production in the United States down by 1.5% relative to what it would otherwise be. That's an increase of 0.7 percentage points on the unemployment rate or so. That would be enough to kick the unemployment rate back from 9.0 back up to 9.7% going into the presidential election year. That would not be a nice thing to do to Berkeley students hoping to graduate in 2011 or even 2012, to send the unemployment rate on an upward rising trajectory. If you go and if you talk to Republican congressmen in the House of Representatives right now, or to their advisors, or to their tame intellectuals, you tend to get 3 answers. One answer is, yes, we know it's insane, but we're team players. A second answer is, yes, but government spending really needs to be cut given the long-term fiscal problems of the United States government. And it's just too bad that it wasn't cut in the past decade, and that we have to embark on good long-term policies now. But if we don't embark on good long-term policies now, when will we? And the third is, don't worry. Cutting government purchases will make businesses think that taxes will be much lower in the future, and you'll get a big boom of business investment spending as businesses become more confident when you demonstrate that you actually can cut back on federal government purchases. Our answer to that is, but you're cutting the wrong part of federal government purchases. That is, this year's spending on current programs is not the U.S. government's long-term budget problem. The U.S. government's long-term budget problem is that the United States government pays for health care for the old and for the poor. And given rates of increase in health care spending in the United States, given the fact that we have a health care system that spends twice as much on doctors, nurses, drugs, and hospitals as any other countries does, and that we don't get especially good outcomes, that we're actually a less healthy population than that of the typical country spending half of what we spend on health care. Given that commitment and those increases in spending, we're going to have to find a way to reform that system. And dinking around with government purchases over the next 6 months or over the next 2 years really isn't going to help, because 2 months increase in Medicare spending on its current trajectory will overwhelm those savings. Another deep political argument. You can't make sense of it unless you know this equation and see how it is that we expect decreases in government purchases to decrease production and increase unemployment, and how at least some people hope, yeah, but decreased government purchases will signal that the government's going to be fiscally responsible, will boost business investment confidence, and will get a big boom. Working against that are the National Federation of Independent Businesses' current surveys, which show that right now, if you ask businesses what they're worried about, they're overwhelmingly not worried about high taxes. They're worried about low demand, about not having enough customers. So, economic environment, in general, confidence in foreigners, government purchases, fiscal policy. Then there are the four pieces of the long-term real interest rate on risky investments. The expected inflation rate, and as I said last time, the Federal Reserve has decreed that it's not going to do anything to try to change people's expectations of what inflation is going to be. It's going to try to keep people well anchored to the idea that inflation in the United States is going to be about 2% per year over the long run forever. And the Federal Reserve is not interested in changing those expectations by raising them to, say, 3%. Although if they did raise them to 3%, and if they did keep all these other variables in this equation constant, that would be a pretty powerful boost to production. Because if businesses would say, inflation is going to be a little bit faster, that means that we'll be able to sell our goods for more in 10 years when these new factories go online. A whole bunch of factories that didn't look profitable to build when we thought inflation was going to be 2% do look profitable when we think inflation is going to be 3%. Even though that would be a substantial boost to the economy, the Federal Reserve's uninterested in going there. Where the Federal Reserve is interested in going is in reducing the interest rate it controls, the short-term nominal interest rate on safe securities, down to 0. It's pushed it to 0 and can't push it any lower. Although across my desk this morning, there did come a story about how the Bank of Sweden had actually begun taxing kind of Swedish banks for having deposits at the Swedish central bank, that it was actually trying to push this in short-term safe nominal interest rate below 0 to get to the situation in which banks would pay businesses to borrow money from them, because otherwise the money would have to sit in the bank's account at the Federal Reserve Bank of San Francisco, and the U.S. government would actually tax it. And probably not as a coincidence, Sweden is now the European economy that's recovering the fastest from the recession. So, conventional open market operations, the Federal Reserve is interested in reducing the term premium, in persuading people that it's not going to raise interest rates quickly, but will instead keep them low for a considerable time. And the Federal Reserve is also out there buying assets in a program it calls Quantitative Easing 2, in an attempt to diminish the total supply of risky assets out there for the private sector to hold, with the idea that if the Federal Reserve reduces the supply of risky assets, well, it's going to raise their price, and if risky assets have a higher price, then they pay a lower interest rate, and that reduces this risk premium on the interest rate out there in financial markets. So the Federal Reserve is out there pitching, if not on this term, at least on this term, and this term, trying to get the economy back to an even keel without causing people to fear that it's abandoned its commitment to long-run price stability. These are the stories people are now telling about the current depression or near depression that we're in, and how the government is trying to get us out of it in various ways. These stories make sense only if you know, and understand this particular equation. And indeed, how we got into this makes sense only from this equation. If you look at what happened to the long-term real interest rate on junk bond quality investments, the real interest rate which really existing businesses that aren't blue chip have to borrow at, if they can borrow at all, and what happened to it at the end of 2008 into and through most of 2009, before returning not to normal levels, but at least to levels so that things aren't getting worse at the start of 2010. Okay. What I did last time was I started the story of the Great Recession and got a fair ways into it. I talked about what I was saying back in the fall of 2008, right? How, yes, we did have a very serious economic situation, and how normal stabilizing monetary policy could not help us anymore, but how nevertheless we were going to get out of our problem with only minor damage, because we had the technocratic knowledge, the policy tools, and the political will to escape from the trap. And right now I'm trying to figure out why I was wrong in saying that. And as I said last time, we really should have been able to escape, right, from the trap that we find ourselves in. That unemployment should not be up at 9%, and the majority in the House of Representatives should not be embarking on policies that might raise the unemployment rate to 9.7% if the Senate and the President fold and agree to the Republican budget and these cuts into short-term spending go through. And it is true that we did get irrationally exuberant about the demand for housing and about the trajectory of housing prices. And we did have mortgage brokers and real estate agents running around the country saying that over the long run, house prices just don't go down. And we did build 5 million extra houses in the swamps of Florida and the deserts between Los Angeles and Albuquerque that really should not have been built. And an average of $100,000 in mortgage debt on those houses was not going to be repaid. And so we did have $500 billion of investments that had been made that were going to be worthless and that someone had to eat. But, as I said last time, the world economy did have $80 trillion in assets. You know, a bad week on the stock market pushes global wealth down by $500 billion. And we have originate and distribute securitization to slice, dice, and spread risks so that even one particular risk going bad to the tune of $500 billion, shouldn't bankrupt much of anybody. Especially shouldn't bankrupt key financial intermediaries whose continued functioning is essential for the flow of finance to continue. It's their business not to get themselves into situations in which a relatively small loss in the global economy creates a huge destructive danger. But there was a trap, and the trap comes out of regulatory arbitrage, right? Investment and commercial banks saying, these mortgage-backed securities are rated AAA. We can hold them for all kinds of purposes and satisfy regulators that we are being prudent, because regulators just ask us to hold securities that are rated AAA. They don't ask us to hold securities that really are AAA. And if there's one lesson for economists from this and for bank regulators from this, is don't outsource key portions of your job to private companies like Moody's and Standard & Poor that don't have your incentives. Right? That Moody's and Standard & Poor make money when banks come to them and ask them to rate their bonds. And Moody's and Standard & Poor are a lot happier if the companies that issue the bonds are a lot happier if Moody's and Standard & Poor give them high ratings rather than low ratings. So given those institutional pressures, it would be a very brave bunch of rating agencies indeed that would continue to be hardliners and continue to rate securities conservatively year in and year out, especially when there's always the threat, well, if you don't rate this bond like we want it rated, we'll go and start another rating agency that will be more complaisant and will be happier and will produce higher ratings. And the trap came from a failure of risk management at the top of the major investment and commercial banks, right, in the United States of America. That you'd expect that the extremely highly paid professionals at the top of the banking system, that they wouldn't want to be caught in the middle of a financial crisis. The last time there was a major financial crisis in the 1930s, a bunch of financiers went to jail. The last time there was a minor financial crisis at the start of the 1990s. Some savings and loan executives went to jail, and others were hounded through the courts for 5 years or so. The chairman and executive officer of Bear Stearns was worth $1 billion in mid-2007. Was worth, well, $50 million by April 2008. You'd think that losing $950 million would concentrate your mind. The possibility of losing $950 million would concentrate your mind. And that if there was one thing that you, as CEO of Bear Stearns, sitting at the top of your organization in mid-2007 would be saying, is don't do anything that might break the bank. I like to be a billionaire. If I have to lose 95% of my wealth and get down to a mere 50 millionaire, that's such a big hit to my status and to my self-esteem, that's such a shameful thing, that I simply won't let any chance of it happening come to pass. Yet when you look around the world of major investment and commercial bankers, you find all kinds of people who have no control over the risks that their banks are taking. A whole bunch of whom see their organizations disappear and who themselves take major, major hits to their admittedly outsized wealth. They're left as rich people, but not as super rich people when the financial crisis hits. You see a lot of people who incur substantial reputational hits because they were supposed to be good at managing risks, and they turned out to be. In fact, there are only two major bankers right now who emerge from the whole thing smelling incredibly sweetly. There's Jamie Dimon of J.P. Morgan Chase, and there's Lloyd Blankfein of Goldman Sachs, both of whom at the end of 2006, at the beginning of 2007, told their subordinates, this housing stuff is simply too risky and too silly. Yes, we can make a lot of money in the short term by continuing to issue and continuing to hold mortgage-backed securities, but we're running unbelievable risks. I want us out of this business. The only two people to say that they want out of this business, and the only two people to make it stick. That is, as I understand it, the top executives of Citigroup and some other banks said that they wanted their subordinates out of this business, but they weren't actually able to follow through. And the people lower down in the bank stayed in it, which was why, say, Citigroup had a large recent settlement with the Securities and Exchange Commission in which it admitted to misleading investors on some of its conference calls about what its earnings were because it had failed to make clear exactly how much mortgage-backed securities Citigroup still owned. So regulatory arbitrage, right? The pulling back of government regulation over the financial system, the creation of loopholes by which banks could hold securities rated as AAA that weren't really AAA for purposes of ensuring that they were safe, and an enormous failure of risk management at the top of the banking sector, produced this huge flight to quality and a $20 trillion loss in global financial value. As everyone said, I don't know what securities we're currently holding, but whatever they are, they're a lot riskier than we thought we were. We don't want any more risk in our portfolio. We want less risk in our portfolio. So we're not going to buy any risky bonds or make any risky loans. In fact, we're going to sell our risky bonds and call in our risky loans, no matter how lousy are the terms that we get. And that's the thing that drives the junk bond interest rate up to 15%, the junk bond real interest rate up to 15%. That's the thing that turns a small initial shock into a big problem. And as I said last time, the depressing thing is that the initial shock was relatively small. On the order of 1/8 the magnitude of the financial losses from the collapse of the dot-com bubble in 2000. And it's true that the problem in the dot-com bubble wasn't the technologies didn't fulfill their promise, but simply it proved very hard to make an absolute fortune off those technologies. Too much competition, too much software piracy, too much excess capacity in the industry. But still, with 8 times the shock, you wouldn't have expected such a teeny blip in the economy in 2001 and 2002, and this huge near depression collapse in production and employment right today. And we could have stopped it by nationalizing housing finance in the winter spring of 2008, by nationalizing as many investment banks as necessary in the spring and summer and fall of 2008, by letting worries about moral hazard go out the window in the crisis, by saying, okay, you bankers have done a bad thing, but we're going to fund you with enough money that no investment bank goes bankrupt, which would have been politically very risky, but even politically risky things are worth doing. Even things that enrich bankers who don't have any legitimate claim to the money are worth doing if they keep unemployment at 7% rather than 10%. Or simply follow the Swedish model and nationalize large chunks of the banking system, take equity, and have the government support the investment banks, but do so by taking a full stock ownership and controlling interest in them. I think it's clear the meltdown could have been avoided, but we did not do that. First, because we thought it wouldn't be American to nationalize large parts of the banking system. And second, because we thought it would not be American as well to give lots of government money to the banks and so rescue several thousand financiers from the losses that they deserve to take unless it were really necessary. And by the time it came clear it was really necessary, it was too late. Underlying all of this, I think, was a belief in the power of the Federal Reserve. The belief that the Federal Reserve had enormous power to change interest rates and to, in general, shape the configuration of asset prices, and that the Federal Reserve was powerful enough to deal with anything the market would throw at it. If you'd gone and if you'd asked Federal Reserve Chair Alan Greenspan back in 2005 or 2006, when the housing bubble was the most bubbly, when TV shows called Flip This House seemed to be showing up every week on cable television, why he wasn't taking firmer steps to regulate housing markets and to try to keep all these borrowers who seemed to be buying houses they couldn't afford and all these lenders who seemed to be making loans without inquiring as to whether the borrowers had any income at all, why he didn't stop them. If you'd asked him, Greenspan would have said something like this, that the housing borrowers are grown-ups. The housing borrowers want to buy and borrow these houses. The housing borrowers, the housing borrowers really want to buy them, and getting 100% no money down, pick your payment mortgage is the way they can do it. And the lenders all want to make these loans. What am I going to do to get in their way? That, for one thing, if I get in their way, they all can write and call their congressman. Can I get between a willing borrower and a willing lender and still survive politically? Or will I be hauled up on Capitol Hill every week to say, who are you, the national nanny? These lenders want to make these loans. These borrowers want to borrow this money. Why are you saying they can't? Why are you getting between them, Mr. Greenspan? What kind of Grinch are you? To do that, if you're simply an appointed technocrat, is a dangerous thing to do. And besides, Greenspan would have said, no matter what happens to the housing market, I can clean up the mess afterwards without major damage to the economy as a whole. After all, Greenspan said, I cleaned up the mess. I cleaned up the mess back in 1987. After the 25% one-day fall in the value of the stock market, I reduced interest rates and there was no recession. I did it in 1991 when the savings and loans sector, when all the savings and loans went bankrupt. I helped the Resolution Trust Corporation clean up the mess and send some people to jail and refinance a whole bunch of other properties and eventually sell them off at a profit or at least a small loss, and I lowered interest rates and there was only a small recession. I did it in 1997-98. First with the East Asian financial crisis, and then in the summer of 1998 when the biggest hedge fund in the world, Long-Term Capital Management, went bankrupt, and then when the nuclear-armed ex-superpower called Russia went bankrupt and announced it wasn't paying its debts and there was no recession. And I did it in 2001 after the collapse of the dot-com bubble. I lowered interest rates in order to keep the real interest rate on risky investments from rising too high, and there was only a small recession after that. I can do that, kind of Alan Greenspan said. And that was the conventional wisdom. I certainly believed it. Right? Nearly everyone believed it. After all, if you could handle the dot-com bubble and the state bankruptcy of Russia by simply changing the short-term interest rates the Federal Reserve controls and not have major damage to the economy, what particular financial crisis could hit the world that would cause mass unemployment? The conventional wisdom back then was that the conventional policy tools of Federal Reserve open market operations could do the job and prevent big recessions. That the Federal Reserve could, if necessary, flood financial markets with nearly unlimited amounts of liquidity. And if markets were liquid enough, there'd be no shortage of demand for currently produced goods and services. Rather, people were thinking in 2007, 2008, the big problem is more likely to be inflation, right, than high unemployment. The big problem, people thought up through the summer of 2008, was that the Federal Reserve will overdo it and in fact push aggregate demand up too high so that even everyone working full-time can't produce all the goods and services people want. And then we're going to have the inflationary spiral problem we had in the 1970s, the kind of economic problem that we're going to cover after the midterm. That was what the general consensus of everyone talking about economic policy was up through the summer of 2008, that the Federal Reserve can handle it, and the danger is that they might, after all, overdo it. And by the end of 2008, after the bankruptcies of Lehman Brothers and the America International Group, it was clear that was wrong, that conventional monetary policy was simply not strong enough, that short-term nominal interest rates hit zero, and conventional policy could not boost demand anymore. You see, the Federal Reserve did flood markets with liquidity. It did buy bonds for cash at every opportunity. And it produced a situation in which investors could not gain anything in return by trading their liquid reserve deposits at the Federal Reserve away for longer-term Treasury instruments. Yet the deficiency of demand for currently produced goods and services was growing. The real interest rate at which businesses could borrow kept rising. And the problem was that financial markets felt themselves short not of liquidity, but rather they felt themselves short of safe assets, of safety. They felt themselves short of high-rated AAA, really AAA, not just rated AAA, places to park their wealth, where they could be confident it would not melt away when their backs were turned. And that conventional monetary policy doesn't boost that supply of safe assets. All that does is it trades one safe asset, cash, for another safe asset, a government bond. Both are quite safe. Both only lose their real value or their nominal value in some Mad Max-like scenario. One's more liquid than the other, one's more easy to spend than the other, and it's true that if interest rates are high because the market feels short of liquidity, as it did back in 1982 or even 2000, such a boost to the liquidity of the economy can move interest rates. But if you've reduced short-term safe nominal interest rates to zero, and if long-term real risky interest rates are still so elevated, it's not that the economy feels short of liquidity, it's that it feels short of safety. That can't be fixed by conventional monetary policy, by standard open market operations. It's done all that we can. And thus, by the end of 2008, we were in the eventuality that two economists, at least, had warned me might come to pass back at the end of 2007. And those two economists were our very own George Akerlof, up in the economics department. Although, alas, he's not around here anymore because his wife, Janet Yellen, is now vice chairman of the Federal Reserve Board, and they've moved to Washington, D.C., so she can be near her job, which is a full-time 9-to-5 job. Was George Akerlof. But if you ever saw the Nobel Prize banners that the university and the city of Berkeley put up periodically, these banners of all the UC Berkeley Nobel Prize recipients, down Shattuck, down Telegraph, down Bancroft. I don't think they put them on Hearst. You could walk by there and you could look up, and there you'd see George Akerlof's face there because he had won the Nobel Memorial Prize in Economic Science for analyses of markets like finance, like healthcare, like used cars, in which the buyer doesn't know the quality of what the seller was selling. In fact, I remember walking up Bancroft Avenue once with George and with a Columbia professor, Joe Stiglitz, who had shared in that same Nobel Prize. And you could see Joe Stiglitz looking up at the 10-foot banner picture of George Akerlof, looking down at him, and thinking, Columbia University didn't do anything like this for me. Not only do they have better weather at Berkeley, but they also treat their Nobel Prize winners much, much better as well. So George Akerlof warned me we might be in this situation. And Peter Diamond, MIT professor, also Nobel Prize winner, currently nominated by Barack Obama to sit on the Federal Reserve Board. His nomination has been stalled by the Republicans for, I think, 9 months now, for no conceivable reason I can imagine, no conceivable rational reason I can imagine. Warned me at the end of 2007 that I was overestimating the power of the Federal Reserve to deal quickly and easily with things like this, with financial crises of the magnitude that it seemed threatened. And so what I have to say now is that there's a reason that George and Peter have Nobel Prizes and I do not. Right? That they see more fully and more correctly into the future and understand more about the state of the economy than I do. And I've resolved to listen to them even more carefully in the future. But even though the Federal Reserve had maxed out, had pushed the short-term safe interest rates it controlled to zero, had flooded the economy with liquidity, there are still plenty of other tools. There's the possibility of convincing people that prosperity is just around the corner somehow, of job owning to boost investor and business confidence somehow. There's expansionary fiscal policy. There's the last resort of saying we really would like the inflation rate to be a little bit higher, please, than it is now. There are asset purchases and guarantees to increase the supply of safe and decrease the supply of risky assets out there in the world economy that could affect the risk premium. There are promises to keep interest rates low for a long time in the future that could affect the term premium. It was not the case that the government was powerless. kind of back at the end of 2008. There were still plenty of things that could be done, that the Federal Reserve could do, that the Treasury could do, that the Congress could do at the end of 2008. And thus my personal confidence back then that we were going to get out of this thing with only minor damage to the economy in terms of elevated unemployment. For we did have the technocratic knowledge, the policy tools, and the political will to escape from the trap. What could we have done, even if short-term safe nominal interest rates are at zero? Well, Congress could have undertaken fiscal expansion. The American Rehabilitation and Recovery Act, what Christy Romer calls the Recovery Act. Congress could act by pulling government spending forward from the future into the present and pushing taxes from the present back into the future. That after all increases in production and employment happen because somebody decides to spend their money faster. Even if you're a fundamental monetarist, even if you're Milton Friedman, you think that expansionary monetary policies work because if you give more people cash in their pockets, they step up their pace of spending. And in this case, the federal government's money is as good as anybody else. If the federal government steps up its spending, that's as good a thing to do to boost the economy as if a private individual who has more money in their pocket steps it up. That's going to put people to work just as well as private spending. And so, furthermore, when the federal government spends and borrows, it expands the supply of safe assets. It creates more safe bonds for people to hold. And to the extent the problem is that people don't have enough safe bonds in their portfolios, it relieves that part as well. So that's one thing that we could have done, fiscal expansion. And in fact, Christy Romer carried up to President-elect Obama in December of 2008, say plans for 3 possible fiscal expansion measures. One that would spend $600 billion over 3 years, one that would spend $800 billion, one that would spend $1.2 trillion. In the end, the Obama administration decided to go for the $800 billion one and actually got about $600 billion of fiscal expansion over 3 years through the American Rehabilitation and Recovery Act. Turned out not to be nearly big enough. If you ask people who worked for Christie why did they do $600 billion rather than $1.2 trillion, they will say, well, we tried for something larger, but we weren't that upset because we thought if this isn't big enough, we'll get another bite at the apple. And if it turns out that the Recovery Act #1 is not large enough, we'll do Recovery Act 2. And the Congress will easily fall in line if it turns out that unemployment is rising faster than we projected. So actually only getting $600 billion in their first month of the administration is a major victory. We shouldn't go and try to boost government spending much more, or shouldn't make that an extraordinarily high priority. Big mistake because Congress essentially froze up into gridlock, right, after its first month and a half. And very little else got passed with the exception of the health care reform bill, which got through by the skin of its teeth. That turned out to be their only bite at the apple. Being happy with something that they thought was smaller than would be optimal because they'd be able to go back and take another bite turned out to be a substantial political mistake and left us with fiscal expansion that wasn't big enough. But that was only one of the things that they could do. The Federal Reserve could act in an extraordinary manner by engaging in quantitative easing policies, not by increasing the amount of liquidity in the market and lowering short-term safe nominal interest rates, but by taking various forms of risk off of the private sector and onto the Federal Reserve's book, thus decreasing the amount of risky assets the private sector would have to hold. Decrease the supply of risky assets, you're going to raise the price of risky assets by supply and demand. When the price of a risky bond goes up, its interest rate goes down. These policies of quantitative easing tend to reduce the risk premium and act even if normal monetary policy can't work anymore in order to reduce the interest rate at which businesses actually have to borrow. The Federal Reserve's now engaged in quantitative easing too. It's pursuing policies along these lines. The only complaint I have is that it's too late and too small. That this was something they ought to have been doing at the end of 2008, rather than saying we should wait and see what shape the economy's in and then act again if necessary. It was pretty clear it was necessary by the beginning of 2009. So quantitative easing. There's also raising your inflation target, saying we'll be happier with a 3% or a 4% inflation rate for the next 10 years rather than a 2% inflation rate. Back when Ben Bernanke was just Professor Bernanke, writing about the Japanese economy in the late 1990s, he wrote a bunch of papers about how raising the inflation target is a good way of dealing with financial crisis-caused recessions. That Professor Bernanke doesn't seem to be the Federal Reserve Chairman Bernanke we have now. In fact, Bernanke has been quite strong that he's not only not in favor of raising the Federal Reserve's inflation target, he's not in favor of even announcing what the Federal Reserve's inflation target is, at least not as long as he's sitting in the hot seat. Other things you could have done. The Treasury, right? The Treasury Department could recapitalize and guarantee banks. And they did that. They announced they were conducting a whole bunch of stress tests. They announced they'd looked at all the banks' risks and their capital, and they were happy that these banks weren't going to go bankrupt. And I actually have not looked at the details of the stress tests enough to understand whether the banks were in a situation in which virtually nothing that could happen would bankrupt them once you got through the crisis at the very end of 2008, or whether the stress tests were simply a way for the Federal Reserve to say, we promise we won't let these guys go bankrupt, that we're backstopping them no matter what. You can lend to a bank without worrying that your money would vanish. And if you can give your money to Citigroup or to Goldman Sachs or to Morgan Stanley or to JP Morgan Chase and be able to sleep easily because you know the Federal Reserve won't yet let you lose it, that's a very nice place to park the part of your portfolio that you want to hold in safe assets. That diminishes the excess demand for safety. You can engage in targeted nationalizations of businesses that can't borrow. That if businesses have to pay the long-term real risky interest rate when they borrow, but the United States government doesn't. Right? The United States government, no one thinks it's going to go bankrupt. If it nationalizes a company and then takes over its program of investing, it can borrow at a much lower interest rate and so can keep investment spending rolling forward, even if no private businesses can. We did this with the autos. We've now reprivatized them. It seems to have worked quite well with GM and with Chrysler. The Treasury could have simply turned itself into a giant hedge fund, gone up and bought a huge amount of risky assets and put them on its books, with the idea that the market's irrationally depressed now, just as it was irrationally exuberant in 2006. And if the Treasury buys risky assets cheap, not only can it improve the supply-demand balance for risk in the private sector, but it can also make a ton of money. They had a program, a public-private investment program, to do that. Or they can reorganize mortgages, the so-called HAMP program, to assist banks and to encourage banks to refinance and renegotiate mortgages in such a way to make it clear who owes what and to greatly decrease the amount of risk faced if you get into the mortgage business on either side, on either the lending or the borrowing side. Those are an awful lot of things. Those are an awful lot of things that you could do. And indeed, back at the end of 2008, I thought that the U.S. government was about to try to do all of them. That we weren't certain which would be most effective. We weren't certain which would be most politically palatable. But you go ahead and you try to do all of these things. And some of them are going to work. And whichever one works, you reinforce it. And so you avoid a deep recession. This is, in a way, an application of a rule set out by one of the editors of The Economist of London back in the 1870s, I think, that the big problem in a financial panic is that the real risky interest rate at which businesses need to borrow to continue their operations and add to their capacity, that interest rate has spiked. That interest rate has spiked because nobody is certain that anyone else will still be around in a year to pay back their debts. That there's a panic because everyone fears universal bankruptcy. And the way to deal with that is for the government to lend money to everyone as fast and is as large an amount as possible so that whoever is asked for their money by their creditors can pay it off, but to lend at a penalty rate so that whoever winds up having to resort to the government for aid rather than to go bankrupt winds up unhappy. That they either wind up with a very large debt to the government that leaves them poor, or indeed the government takes their equity and winds up owning their businesses, winds up nationalizing it. To lend freely to kind of organizations that might be in trouble, but to do so at a penalty rate, is kind of the essence of dealing with financial panics, and I was confident that everyone understood that, and so we would do as many of these. How many were there? 7 different policy measures as possible to keep unemployment relatively low. That 10% unemployment seemed to me politically unthinkable, and 9% unemployment for any substantial period of time seemed to me to be doubly politically unthinkable. I thought we were going to use these particular tools. And indeed, if you go and if you talk to people who worked for the Bush administration or for the Obama administration, one line you'll get is that we did use them if we'd followed the policies that the House Republicans are now recommending. No troubled asset relief program, no public-private investment partnership program, no HAMP, no American Recovery Act, no nothing. The unemployment rate would have peaked not at 10% but at 16%. And that you're asking too much to complain that we didn't keep the unemployment rate from going above 7%, when instead we kept it from going more than a third of the way, from 7% up to 16%. We actually did a pretty good job. And there's a point to that. But I expected more, especially because 10% unemployment is itself extremely painful. Thus, that was the situation as I saw it back in 2008. And indeed, the incoming Obama administration's belief was that it does the stress tests, it does the PPIP, it does the HAMP, it does the Rehabilitation and Recovery Act. And the unemployment rate is then, they thought at the end of 2008, going to follow this curve right here, as opposed to what it would follow without the Recovery Act, without that increase in government purchases, which they forecast to be this curve right here. That was what the Obama administration thought the most likely outcome was, the most likely scenarios were at the end of 2008. Don't pass our recovery plan, and we do this. Pass our recovery plan, and we do this. And by the first quarter of 2011, the unemployment rate will be below 7%, will be down to 6.8% or so, and then will continue to decline until it gets back to a level of normal sometime in 2013. It's not the outcome, that's not the outcome that we got. We got something different, first because Henry Paulson, as Bush Treasury Secretary, really didn't believe in the penalty rate stuff, that the government needs to charge banks a huge amount for its help in a financial crisis and needs to take them over if they actually can't pay back the government. That, he thought, was too close to socialism, and he was sitting in the Treasury Secretary's seat at the time. And the Obama administration initially underestimated the magnitude of the problem. There was too small a plan A, and then no plan B, and then no plan C enacted. And it's standard, if you kind of wander around Washington these days, to blame the Republicans in the Senate, plus Joe Lieberman, Blanche Lincoln, and Ben Nelson, for the failure for there to be Plan B and Plan C, and for the too small size of Plan A. That Nancy Pelosi could have gotten Plans B and C through the House of Representatives in 2009 and 2010. But given the role of the filibuster in the Senate, you couldn't get anything other than the Recovery Act and health care reform through the Senate in 2009 and 2010. And that leaves us with our current situation, in which current forecasts see the unemployment rate still kissing 9% late in 2011 before starting to decline in 2012. And by the end of 2012, we expect the unemployment rate to be something like 3 percentage points higher than the Obama administration expected back at its start. Why did things go wrong? Well, as I said, Henry Paulson, as I said, initial underestimation of the problem, as I said, expectations of a second bite at the apple, problems with the Senate. But it was clear by February 2009 that the situation was much worse than plans made in December 2008 had reckoned. By 2009, it was clear there was time for a Plan B. So let's look at these 7 tools. We did fiscal expansion, but at half the size that Christina Romer now wishes that we'd done it. We did some quantitative easing in 2008, and then the Federal Reserve stopped until after the midterm election and only started doing more quantitative easing policies to take private risk onto its balance sheet after the midterm election, and it's undertaken its quantitative easing 2 program since I made this slide last October. Raised the inflation target? No. Recapitalize and guarantee banks? Stress tests? Yes. Targeted nationalizations? Well, we nationalized the auto companies, but we didn't nationalize any of the weak banks. And the other 2, taking private risk onto your balance sheet, quantitative easing by the Treasury, and reforming the mortgage market. The Treasury turned out to be unable to do any of those. And you can look at this last 2 ways. You can either say half empty or half full. That for Tim Geithner to manage to get the Treasury to conduct 2 successful policies that boost production is a major accomplishment, given the difficulty of getting things done in Washington. But on the other hand, there were 2 policies he really should have gotten in motion that he was unable to do so. WISP is a 50% at this, a grade of A, a grade of B, a grade of C, or a grade of F in the job of being Treasury Secretary. I don't know. What I do know is that Tim Geithner is doing a much better job as Treasury Secretary than I would have done had some mischance put me in his shoes. He has a great many of the strengths for the job, and he's using them. How much of this can the Obama administration really blame on Republicans? Well, yes, the Senate has its institutions, has its filibuster, but that could have been reformed. It was Bernanke's decision not to do any additional quantitative easing between the end of 2008 and the midterm election. But Obama appoints the Federal Reserve Chair. Obama appointed Bernanke and did not make filling empty seats on the Federal Reserve Board that high a priority. And there seems to have been, once it was clear that things weren't going right, a general failure to unify economic policy advisors beyond a Plan B. But if you go and if you talk to all of my friends about what should have been done, you'd say that Peter Orszag at the Office of Management and Budget would have said that the Congress is simply not going to pass anything large enough, and so what we should do is get Congress to pass what we can, and otherwise concentrate on reforming the long-run budget in the hopes that that will restore the confidence of business, that that's the only option. Christy Romer was very much in favor of additional aid to states to keep them from cutting back on their spending. Jared Bernstein in the Vice President's office wanted a payroll tax cut more than anything. Larry Summers in the White House wanted an infrastructure investment program more than anything. Tim Geithner wanted a lot of little fiscal stimulative things, each of which would be dear to the heart of a different marginal senator, and so you can pass 8 little things, and together they might add up to one big thing. But a failure to get all the advisors on board behind a single, integrated, united plan, a failure to get the Obama administration's economic policy makers as a unified group, saying you have to do something and this is what you have to do, as opposed to having 6 people wandering around the White House, each with a different idea about what should be done. And so given that, there are issues of control and priorities, right? That 50% of the job of being president is picking people for jobs and then backing them when they get into trouble, or deciding to throw them over the side when they get into trouble and when you no longer want the fight. And 40% of the business of being president is out there explaining what you're doing to the public. And only 10% is actual policy making, which takes the form of refereeing fights between your advisors when they disagree. And, there are lots of things to do. There's macroeconomic recovery, there's the attempt to reform the financial system, there's dealing with climate change, there's healthcare reform, there's the entire international affairs portfolio of the president, there's lots and lots of other things. That if you're working 60 hours a day, you only get to spend 6 hours a day on real policy making, on making decisions when your advisors disagree. If macroeconomic recovery is one of the 10% of your time, is one of the 10 issue areas you have to deal with, that's 36 minutes a week briefing for and making the major economic policy decisions, which is really not a hell of a lot of time. Right? 36 minutes a week is not a hell of a lot of time to actually make decisions and get up to speed if your advisors don't have a single unified plan that you need to follow. And here it gets puzzling, because Barack Obama is, like all presidents, a politician. And you'd think that macro recovery would not be something that you would let fade to the back burner. You'd think it would get the 36 minutes a week and perhaps 2 or 3 times as much. Given that if you look at the world over the past, since World War II, how fast the economy is growing up to a midterm election has quite a large correlation. With what happens to your political base in Congress. That unless you're unlucky and are Harry Truman and people don't like you because you've just gotten the country involved in the Korean War, if production's growing fast, your base in the House of Representatives is pretty certain to still be there. If the economy's shrinking, unless you're Eisenhower in 1954 and have just ended the Korean War, you're in trouble. But if you're Reagan in 1982 and look like everyone's grandfather and can promise everyone that prosperity is just around the corner successfully, you're in less trouble than otherwise. If you're Clinton, people either hate you or love you, depending on different times, and I think that's a fair depiction of Clinton's personality. Nevertheless, you'd expect a politically oriented White House to have been much more focused on macro recovery than it has been over the past 2.5 years. And I want to kick that question to the political scientists. I don't understand why the government hasn't done more. With that, I'm going to stop and say we're going to go over the sample exam questions and other exams questions on Tuesday, and then midterm next Thursday.